Hey everybody, Jason Seibel here. I hope everyone's doing fantastic. Today is hump day, so I thought it would be a perfect day to do a video for Homebuyer 101. And today's video is going to be about the DNA of an interest rate and how it's decided, comes together. I have clients all the time ask me, well, why is my rate 4.25 when my neighbor's is 3.75? Or maybe it's a quarter point, or why is mine lower and my neighbor's higher? There's a very specific reason why rates vary from person to person. So let's talk about how that all began, the what, where, when, why. So let's start in 1938 when mortgages were first written. Everybody got the same interest rate. Didn't matter down payment, credit score, any of that. And that model ran all the way until 2009. By the 1990s, we had a secondary source of loans called subprime. Those were people who couldn't qualify traditionally, a lot of times small business owners, people who maybe didn't have a strong credit, and there was very much risk modeling going on with those loans. In 2009, when Fannie and Freddie just about went belly up and the government came in and took over, they decided to forensically go look and see why were loans defaulting. And when they went and looked at the metrics, what they found is loans with high loan to value, meaning low down payments and low credit scores, had a higher propensity to default than others. So what they did, the new Fannie and Freddie guidelines rolled out what's called loan level price adjustments. This is risk-based pricing. So there's more than 30 variables that impact an interest rate now. Okay, so it's really like a car insurance model. So in a world where you have a clean driving record and I have 2 tickets in an accident, it's generally accepted that I'm going to have a higher car insurance premium than you. Well, the new model for lending applies something very similar than the car insurance industry. So now there's over 30 different factors and variables which can impact your interest rate. So if everything from credit score to property type to is it owner occupied, is it an investment property, but in this day and age, that is why each loan is evaluated case by case. Everybody has their own DNA, and you could see an interest rate vary from an owner occupied on a 15-year fixed to a non-owner occupied with a low down payment and a low credit score. You can see a 2% swing in rates. So I have a slide specifically to talk about this in my buyer consultation packet. If anybody is interested in seeing a copy of that, I'd love to send it. Let me know by text, email, phone. Otherwise, until next time, thank you so much. I hope you have an awesome day. Hey everybody, Jason Seibel here, Homebuyer 101. Excited, it's Friday, excited to reach out to you today. I've got my guest, Lisa Nishioka, who's the owner of Xanadu Real Estate, and today we're going to be talking about house hacking, the new strategy for acquiring real estate that we're seeing in the marketplace. Now, to the point where there's books being written about it, I've seen articles, but yet when you ask people in the marketplace, most people don't know what it is. So, Lisa, what is house hacking?
Well, my son came to me a few months ago and says, Mom, I'm making all this money. What can I do? And I said, well, we could buy a house. And he's like, really?
I love it.
I like that idea. He is 20 years old. He can buy a house, a 3-bedroom house, rent out 2 bedrooms to his friends to help him with the mortgage or put some money
that helps
savings
mitigate
away.
the expense, right?
Right, but then aren't there some rules with him owner occupancy for over 12 days?
So when you buy a house, it needs to be owner occupied for the first 12 months. That's on the note that you sign. But after 12 months, all bets are off, and you can convert that to a rental or do whatever you want with the property, which then opens the door to convert that to a rental, right?
Nice.
So if your son were to bank the money,
he could buy another house.
12 to 18 months later, he's going to turn around, buy another house, bring his posse with him, and then convert that first house to a rental and put a family in there and have a passive income stream, be building equity, and he can continue to do that over and over and over again.
So making it like a chain of reaction, continuing to do houses, buying it, renting out the rooms with his friends in it, continuing to move on to the next house.
Until they wisen up and want to do it for themselves.
Right.
Right.
Yeah, so we
That's
need
a
to be
start.
in first.
That's right. That's a
So
start.
So do you know what kind of people are actually doing this? I take it would be first-time home buyers because they
It
would
is. So,
definitely.
so we're seeing millennials and we're seeing first-time buyers, and the reason behind it is, they're getting married, starting families later, so they have additional time where they're living with their friends and being single and having a great time and taking advantage of that time when they don't have, the stress of raising a family and such to do this. So if they're going to live and do that, why not accumulate assets while they're going? It's brilliant.
Right.
Leave it to the millennials to figure this out.
Right. And the housing market has been still increasing rapidly. It's between 4 and 6%. What's your interest rates like?
Well, like I said, 4 to 6% expected appreciation growth this year. Interest rates are expected to be up about 0.5% this year. So it's definitely, timing is good because in an increasing rate market and price market means you get less for your money. So you definitely want to strike while you can.
Right, and actually having a New Year's resolution. What is your New Year's resolution? You should probably get into house hacking. Would you
Awesome.
agree?
Hey, why not? We're here to win. We're here to help our friends and families win as well. So thank you for joining us today. Again, this is Jason Seibel, Lisa Nishioka. If you have any questions, reach out to us by phone, text, or email. But thank you so much. Until next time, all the best.
Have a great day.
Hey everybody, Jason Seibel here, Homebuyer 101. I hope you are all fantastic today. It's Wednesday. Got another video for you, and today's topic is what is the difference between down payment versus cash to close? I get a lot of questions, and many people are surprised by the difference when we put together an estimated statement, cost, cash to close, and they're like, man, why are these numbers different? So let's talk about that. Down payment. The definition of down payment, that is your minimum contribution required to qualify for the loan. So cash to close is all of your closing costs plus the down payment, right? So your closing costs include things like lender fees, prepaids, title and escrow fees, property taxes, and those are either paid out of pocket or they can be negotiated in as part of the sales price, or you can ask the seller to pay those costs, okay? In our market, typically your closing costs are about 2.5% to 3% of the purchase price. I'm going to run through a quick model for you to give you some examples of how this would work. So on a $300,000 purchase, okay, at a 5% down payment, what that would mean is your down payment, your minimum contribution for the purpose of the loan would be $15,000, okay? Your closing costs, let's just use the round number of 3% on that same purchase price of $300,000 would be $9,000. So your total cash to close would be the down payment of $15,000 plus the $9,000 for a total of $24,000. That's what you would need to bring to the party to close on your new home. Now, if you ask the seller to pay a portion of your closing costs and negotiate that into your contract, let's say you ask the seller to pay $5,000. So what that would mean is $15,000 as a down plus $9,000 for the closing costs would be $24,000. But if the seller pays $5,000, you would subtract that $5,000, and now your new cash to close would be $19,000. So it's super important as you're exploring this process of buying a home to make sure that you have the appropriate cash you need to close, because it can be different than your down payment. And there's a lot of sources. It could be gifts, it could come from a retirement account, it could come from your personal bank account. But make sure you talk with a professional mortgage advisor, somebody who can help walk you through that process and tell you exactly where you need to be so you can move forward in your new home. If you have any questions, reach out to me. Otherwise, you can hit me by text, phone, email. But until next time, have an awesome day. Thank you. Hey everybody, Jason Seibel here, Homebuyer 101. Hope you're doing awesome today. Today is Wednesday and we got another video to shoot. And today's topic is going to be loan discount points and how they work. So what is a loan discount point, or points as it's called in the finance world? What it is money that you pay to buy down or lower the interest rate, okay? A good rule of thumb is for every eighth of a point in interest rate, it costs about a half point. As you move further up the chain, it tends to be more expensive, but for an eighth, it's typically a half a point or 0.5% of the loan amount. So on a $300,000 loan amount, that would be $1,500. For a quarter, to pay 1 point to get that lower rate, it would be about $3,000. So the cost tends to get more expensive due to demand. That has to do with investors and hedging and stuff. So I'll make it simple. If the market is demanding 4% and you've got somebody who wants to sell you a bond at 3%, you're going to have to pay a little bit of premium up front to be able to get that rate, because there's risk on that rate of return. So if the loan sells off too soon, too late, they're not going to get that 4%. So, which is why rates progressively get more expensive as you move up the chain, typically. So let's talk about the numbers and the importance of it. So on a $300,000 loan, if you were to buy the loan down 1/4 point in rate, that would cost in today's pricing 1.09%, which is on a $300,000 loan, $3,240 of a fee up front. Okay, and what that gets you in return is a savings of $44 a month. So if you divide those two numbers, the break-even point on that point is going to be 74 months, so just over 6 years. So what that means is you will recover that upfront money in 6 years, and anything longer than that, you'll actually be saving $44 a month for the remaining life of the loan or until you sell. So points can be a fantastic tool. Here's where it goes negative though. The average loan currently, according to Fannie Mae, is servicing is about 34 to 36 months or 3 years. So if you pay points and then you're not in the house long enough to recover those dollars, all you're doing is paying the bank a premium each time you write a loan, and we do see that quite often. So there's definitely a delicate balance. What you want to do is really get into that break-even analysis, look at your short and long-term goals and make sure it makes sense. Now I'll give you an example. This past fall, I had a client pay $14,000 to buy down the rate. And when I went to lock test, they thought it was a little bit crazy. But if you look at it from a bigger picture, it fit their short and long-term goals, because they're a single income family, his income's going to be growing, his wife is going to be going back to work at some point in time. So what this did in the short run, it saved him $200 a month to buy the rate, to pay the cash to buy the rate. And then at that 6 to 7 year mark, they were going to be saving $200 a month over the life of the loan. So it fit their short and long-term needs. So points can be a fantastic tool, can be a blessing and a curse. It all just depends on the analysis. So if you have questions, reach out to me. I'd love to run you through and look at side-by-side scenarios and make sure it's the right fit for you and your family. But all the best.